Welcome back, guys. Now, we're going to be talking about a lot today, so I want to keep the pace moving. But first, we're going to be discussing whether you should be investing in index funds or individual securities, or maybe a little bit of a mixture of both is right for you. And of course, ever since we're talking about index funds, we're going to hear from Warren Buffett, as I think he's probably the biggest advocate for index funds. Now, after we do that, we're going to get into Vici Properties. They had their earnings report released yesterday, and I saw a lot of good news on there, so I want to touch on a few key points with them. And then we're going to wrap up with this tweet that I saw yesterday. I was absolutely befuddled, just like this guy, when I saw Alphabet stock where it was. But let's get into today's episode. We're going to start off with a portfolio update. Now, guys, this is my main portfolio, and it's on display for you guys. Every episode that I release, you're going to get to see this portfolio in action. So I'm currently sitting at $1,076, and I'm down almost 10%. All right. Now, if I scroll down to these holdings, I invest $10 a day into these holdings. So I'm not necessarily investing literally $10 a day. I might do $30 one day, $20 next day, and take a couple days off. But these are the holdings that I'm investing in, okay? And notice that I'm invested in VU and I'm invested in SCHD. So I have one ETF that tracks the S&P 500, and then SCHD, which tracks the US Dow Jones, US Dividend 100. And then the rest of these are all obviously individual holdings that I've checked out the finances myself. I love what these companies do. So just keep that in the back of your head as I go through today's episode. But let's get into whether you should be investing in index funds or individual securities. And we're going to start off with a message from Warren Buffett.
I think it's the same thing that makes most sense practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in one century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8% and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
So there you have it. Warren Buffett, the greatest investor of all time, he says, buy S&P 500 index funds and buy them consistently. He says buy them through thick and thin, because American businesses, they're always going to be just fine at the end of the day. And then buy funds that are low cost. And that's what I want to start off with here. So this is what I deem to be the best index fund. This is the Vanguard S&P 500 index fund. And now when he's talking about a low cost index fund, he's talking about this right here, the expense ratio. So this is where you can see this is low cost. It's 0.04. That is a low cost index fund. So I think that's the best. And second best, I think, is this one right here, the Fidelity S&P 500 index fund. This is also low cost, okay? The expense ratio is 0.02. So that's what he's talking about with a low cost index fund. And these are two good examples for you. Now, I made this video and I posted it earlier, and right away I got a comment about me referring to VU as an index fund. Now, guys, VU is not an index fund, it's an ETF. It tracks the S&P 500 index, so it's not an index fund. And I'll make a video on that later. The difference between an index fund, a mutual fund, and ETFs. But I'm not going to get too far into it now. But at the end of this video, I will tell you what I think is better to invest in, an ETF or an index fund. But I'm not going to get into that now. But I really want to tell you guys who I think investing in an index fund is for. So who is this for? Let's start off with this. The S&P 500, the average return is about 10% a year. So if you look at this and you have, let's say you invest $1,000 over 10 years, $300 at the beginning of each month, you have $63,000. So if you just set it and forget it, you have $63,000 at the end of 10 years. Now, after 20 years, you have 223,000. And after 30 years, you're going to have 641,000. Now, if you have more time on your side, let's say you're 30 or younger, this is where the compound effect really kicks in. You're going to have $1.7 million. Now, let's say you don't have that much time on your side. Let's say you only have 30 years. Just ramp this up a little bit, guys. $500 a month. That's all you got to put in, and you're going to have $1 million after 30 years. Let's say you don't have that long. Let's say you only have 20 years to invest, and all you want to do is set it and forget it. If you at least put in $750, you're still going to have a decent chunk of change, $549,000. So who is this for? This is for someone who wants to buy this index fund and just set it and forget it. That's basically the same thing that I do with VU, right? I buy it and I don't have to monitor it at all. All it does is, well, right now it's losing, but all it's going to do is just compound and make me money over time. So that's exactly what this is for. So that's it for the index funds, but I really want to get into individual securities. Now, if you're someone who takes pride in investing and really wants to get into it, I think investing in an individual security is for you. I do the same thing, okay? I show up to work and I have Microsoft. So why would I not invest in Microsoft? All of these companies I'm invested in not only on this account, but in real life. I have MasterCards, okay? I use MasterCards. I go to Vegas. I spend time at Vici's properties. I buy my gas at Chevron. I go to Costco. I make the joke to my wife all the time when we walk in. I own the place. I live in Texas, so I have Atmos Energy. Again, I live in Texas, so I see the Union Pacific trains all the time. And guys, I have like 3 McDonald's within a 3-mile radius of my house, and you will find me down there. But also you can notice that I have a little bit of a mixture of ETFs. So I think having a little bit of balance, but also taking pride in what you're invested in and checking out the financials, there's a huge positive to that. But I will say there's pros and cons to investing in individual stocks. The pros, there's no fees really at all, and you get to understand and take pride in what you own. The cons is that it's a little bit difficult to diversify. I know I would just buy tech stocks left and right if I could, but I have to stay a little bit diversified, and you have to constantly manage this, especially like I'm always playing with these numbers over here, or I don't want to buy any more Costco. I want to buy some of this. But compared to an ETF or an index fund, you literally just rack the money up into this account. So I want to invest in, the Vanguard S&P 500 index fund. I'm just going to keep throwing, $500 a month in there and watching it grow just like I showed you here. So what do I think is better? I don't think one is better than the other. I think it's all on your style. So if you're someone who just literally wants to set it and forget it, you can use an index. You can buy an index fund and use that as your strategy. If you're someone who thinks you can beat the S&P 500 or just wants to have a sense of pride in the companies that you invest in, then definitely buy individual securities. Or if you want to chase dividends, you can buy individual securities. But I will tell you, VU is an ETF that tracks the S&P 500 index and it pays dividends. So I think my opinion is that ETFs nowadays are better than the older index funds that I believe Warren Buffett's talking about. I think there's so many great ETFs out there to buy. I think ETFs are the way to go. Now, moving on to the next part of this episode. So Vici Properties, they released their earnings report yesterday, and I thought there was a lot of good news. But today, there was really no movement in the stock, right? So it didn't prove to be as good of earnings as what I was thinking. Now, people weren't just loading money into the stock, But I have a few key points here that I want to point out. There's 4 key points here that really were a huge plus for me. Now, let me get this thing settled. So, their total revenues increased 20.3% year over year. So that's a huge positive, guys. 20% increase in total revenues year over year. That's fantastic, right? So moving on, their AFFO, this is huge for REITs, but to common stockholders, it increased 16.4% year over year. That's another huge plus. And then, what else did they do? They completed the Rocky Gap Casino Resort acquisition. So they acquired all of these casinos and real estate, and then they also have 4 gaming properties in Alberta, Canada. This is their first reach into Canada. So they're growing huge. And then lastly, they increased their quarterly cash dividend to 41 cents per share. This is a 6.4% year over year increase. So this is a lot of great news from Vici. As I've already showed you guys, I'm invested in Vici. I love Vici, and I'm going to keep piling money into them, right? So let's wrap this thing up. I saw this tweet, and I kind of was like befuddled. That's the only word I can think of. I keep using it. Befuddled. I was befuddled to see Alphabet stock just get absolutely crushed. It was down 8.97%. I saw this and I went and I looked. And guys, today it dropped another 2.65%. Over the past 5 days, this thing's down 10.89%. Well, how could that be? Why is that? Well, they're saying that Alphabet, it's because, really what they're saying is because it's the Google Cloud, okay? So they're saying it's because of the Google Cloud. But if I go over here to their earnings report, which they also released this week, the Google Cloud, it only provides them $8 billion in revenue. So, well, you can ask just like what I'm asking. They have way bigger portions of their business that makes them money. They're advertising $59 billion. Google, so between Google search, the YouTube ads, that's $59 billion. And now people are saying because of the Google Cloud not doing well, that's why their stock looks like this. Guys, Google is a top 3 cloud company. It's like Microsoft, Amazon, and then Google. If you don't think Google's going to compete with the cloud, you're crazy. So for the stock to drop like this, I'm going to have the same reaction as this guy. Google down 9%. Today is absolutely wild. I am in the same boat as this guy. This is a phenomenal business. So if I were investing in growth stocks, I would 100% pick up a ton of shares of Google, or as much as you could afford. Now, it doesn't pay a dividend, so it's not going to fit into my portfolio here, but I do have them in VU. So I think that this stock is going to jump immediately, okay? Next year, I wouldn't be surprised. I'm going to make a little bit of a prediction here. I wouldn't be surprised if you look at their max. I wouldn't be surprised if it hops all the way up and beyond here. I wouldn't be surprised around this time if we see it around 155. So that'd be quite the it's quite the opportunity to invest in Google as a growth stock. So to wrap this thing up, I think that you can do both. You can invest in individual securities and index funds, just like what I'm doing here. You can invest in individual securities and ETFs. You can invest in only individual securities. You can invest in only index funds. It's all about your style. So if you want to just set it and forget it, like I've said a million times, then either an index fund or an ETF is for you. And if I were to pick between the two, I'm definitely picking an ETF. An ETF pays dividends, and there's more taxes to pay with an index fund. So I'm 100% absolutely going with an ETF. But what I think's best is a little bit of a mixture of the two. It keeps you in the game. It keeps you interested in what's going on with our economy. What's going on with all these big companies that makes our country go around. And that's what I love about this. So that's it for today, guys. Thanks for watching, and I'll see you in the next episode.